you would have to get the regulators to put a limit on the banks. So right now there's no limit. The banks have no limit on what they can short. So if JP Morgan, HSBC, or whoever it is, wants to short a couple 100 million ounces of silver tomorrow, no big deal. They can do it on a click of a mouse. There should be a system in place whereby we know what the world supply of silver is. It's about 820 million ounces last year, approximately. So, the bank should be just like a regular bank. You're allowed to go 10 times above your deposits. So you can't expose your bank, more than 10 times than what you currently have from your clients on deposit today. So that's a number. 10 times is what the banking system uses to manage their books. So if you limit, you got 820 million ounces of production, you limit the banks to 8.2 billion ounces at any given time. That at least limits them, and they can't go beyond that number, and that gives the producers at least a little bit of room to make a little bit of extra money. And what does a producer do? And this is really what drives me crazy: is producers supply communities with wealth. We educate thousands of children. The schools and the communities that we're active in were built by us in many cases. We supply the water infrastructure, the electrical infrastructure, the internet. We supply computers, pencils, papers, garbage collection, waste collection. We do everything. If it wasn't for a mine in a small town in the middle of nowhere, these communities wouldn't exist, and these children would not get educated, and they would not go into universities, and would not have a sustainable life. They'd be living in poverty, and yet the banks don't want the metal prices to go higher. So who are they actually hurting? They're actually hurting these small little communities around the world who can't get proper price for the commodities that these communities are producing. And it's quite shocking, and that more politicians don't come to the forefront and argue this point. And I'm always out there saying, hey, look, who are you hurting? Really, you drive through these small towns, and I've been through many of them. And from the early days in Africa, to my current position, in Mexico, it's the amount of wealth that the mining sector creates is phenomenal. Yet, we don't get the support from the governments because they don't want to, walk away from their desks and travel to these communities and see these, young kids walk around in school uniforms with computers in their hands and, wonder where all this money came from, right? It didn't come from the government, I can tell you that. So anyways, going to supply. I don't see any reason why supply is going to increase. I don't know of a large mine that's going to be coming online anytime soon. There's a lot of unpermitted mines around the world that could be permitted, but they're not permitted. So that's up to the individual company. You should probably talk to them and get details on what's the issue, because every issue, every jurisdiction, every project has its own unique issues with them and reasons why some permits take longer than others. But that's really what it comes down to, is really permitting. If governments want to see the green revolution continue on the efforts or on the direction that they want, or at least suggesting they want, the mining sector does not produce enough copper, does not produce enough silver, zinc. You go across the board to basically all metals. We're simply not producing enough metals to meet the demands that the governments are suggesting that we try to accomplish over the next 20, 30 years. And they're just, they're oblivious to what's actually going on in the industry. Metal supplies are dropping in front of our eyes, and the politicians aren't doing anything.
Keith Neumeyer continues his argument by delving into the current state of the mining industry and its struggles with supply constraints. He emphasizes that there are no significant new mines coming online to meet the growing demand for silver and other metals. This lack of new supply is a critical issue that could have far-reaching implications for the global economy. especially as the world moves towards a green revolution that requires substantial amounts of metals. The process of bringing new mines into production is fraught with challenges. Permitting is one of the major hurdles that mining companies face. Each jurisdiction has its unique set of regulations and bureaucratic processes, which can significantly delay the development of new mines. Neumeyer suggests that governments need to streamline these processes if they are serious about achieving their green energy goals. Without an adequate supply of metals, it will be impossible to produce the technologies needed for a sustainable future. Neumeyer points out that the mining sector is currently not producing enough metals to meet the ambitious targets set by governments for the next 20 to 30 years. This supply shortfall is not limited to silver, but extends to other essential metals like copper and zinc. The mining industry is struggling to keep up with the demand, and without new sources of supply, prices for these metals are likely to rise significantly. The banking sector's shorting practices exacerbate these supply challenges. By artificially suppressing metal prices, banks are disincentivizing investment in new mining projects. Investors are less likely to fund new developments if the financial returns are uncertain due to manipulated market conditions. This creates a vicious cycle where supply continues to lag behind demand, further straining the global supply chain for essential metals. Neumeyer also touches on the impact of metal prices on various industries. He notes that the cost of metals like silver is relatively insignificant when compared to the overall price of finished products, such as automobiles. Whether silver is priced at $100 or $300 per ounce, the impact on the final price of a car is minimal. However, for the mining companies and the communities they support, these price differences are substantial. Higher metal prices would translate to greater revenues, allowing mining companies to reinvest in their operations and community development projects. The current situation, where banks have reached their credit limits for financing metal transactions, is reminiscent of the market conditions in 2011. Neumeyer recalls that during that time, similar issues arose, causing significant disruptions in the market. Today, mining companies are facing challenges in selling their metals at prevailing market prices because the bank's credit limits have been maxed out. This situation creates a financial bottleneck, hindering the smooth operation of the mining industry. In response to these challenges, Neumeyer's company has taken proactive measures, such as opening their own mint. This move allows them to bypass the traditional banking system and have greater control over their silver sales. By doing so, they can ensure that they are not as heavily impacted by the bank's shorting practices and credit limits. In summary, Keith Neumeyer provides a comprehensive overview of the current state of the mining industry and the systemic issues it faces. From supply constraints and permitting challenges to the negative impact of bank shorting practices, the industry is at a critical juncture. Neumeyer's insights highlight the urgent need for regulatory reforms and strategic investments to ensure the mining sector can meet the growing global demand for essential metals.
Whether it's 30 grams or 40 grams of silver, in an electric car, whatever the number is, and it's a highly held secret of exactly how much silver is in any kind of automobile or any kind of device that we consume as a human race, because all these numbers are kept, very close to the chest. But nevertheless, it's quite irrelevant if silver is $100 or $200 or $300, compared to the price of an automobile. So, but yet the banks are short hundreds of millions of ounces, and they're feeling the pain today. And I know that for a fact. We deal with the physical market, and yet as a miner, we sell our ounces, and we have to sell our ounces because we're not in the business of hoarding our own ounces. Our institutional investors expect us to take advantage of the current metal prices, and they want to see those revenues and those profits, and that affects the analysts, and that affects the target prices they put on our stock, and that affects the shareholders who own. We have 80,000 shareholders worldwide. If all of a sudden we have no revenues, then that's not going to be very good for our share price. So we have to take advantage of the current metal prices, which we do and are doing. But it's interesting because the bank limits that a lot of these traders have hit their limits. which I remember going back to 2011, the same phenomenon occurred, but it was so long ago that I kind of forgot about it. But now, as a miner, the gold producers and silver producers out there, they're having issues selling metal at current metal prices because all the credit limits are all at their limits throughout the entire banking system. Because there's a delay from the time we sell our ounces to the time we actually deliver the ounces. And that could be a 30-day delay, it could be 60 days, it could be 90 days. And that difference is financed. And the banks finance that on behalf of the mining sector. And that's a relationship that's been going on for decades and decades and decades. And that's just the way it works. Yet now, those limits have come to numbers that have reached a breaking point. And I'm going to spend some time on this topic over the next couple of months and see what can be done from a mining business perspective to see how we can avoid such things in the future. One of the things we have done is open our own mint so we can pull silver out of the banking system. We can talk further about that. But Dunnigan, your question was also on the supply side. I think you had about 10 topics in your preamble, which I should have had a piece of paper in front of me and wrote them all down. But on the supply side, we haven't seen any new supply, and I don't see any new supply. I see less supply.
Keith Neumeyer concludes his discussion by emphasizing the dire need for a more supportive regulatory environment for the mining sector. He underscores the importance of addressing the systemic issues that are hindering the growth and sustainability of the industry. Without significant changes, the mining sector will continue to struggle, and the global economy will face increasing challenges in meeting the demand for essential metals. Neumeyer stresses that the current banking practices are unsustainable. The bank's ability to short hundreds of millions of ounces of silver without any regulatory constraints is creating an unstable market. This instability not only affects the mining companies, but also the broader economy. The artificially suppressed prices discourage investment in new mining projects, which in turn limits the supply of essential metals needed for various industries. The impact of these practices is far-reaching. Neumeyer highlights that the suppressed metal prices are detrimental to the communities that rely on mining for their livelihoods. These communities often lack alternative sources of income and depend heavily on the revenues generated from mining operations. When banks manipulate the market and drive down prices, they are effectively reducing the financial support that these communities receive. Furthermore, Neumeyer calls for greater political involvement in addressing these issues. He argues that politicians need to be more aware of the realities of the mining industry and the communities it supports. By understanding the critical role that mining plays in local economies, policymakers can make more informed decisions that foster a fair and sustainable market environment. Neumeyer also points out the potential benefits of higher metal prices for the global economy. He notes that the cost of metals like silver is relatively minor compared to the overall cost of finished products. For instance, the price of silver in an automobile is negligible compared to the total price of the car. Therefore, allowing metal prices to rise to their natural market levels would not significantly impact the cost to consumers, but would provide substantial benefits to the mining industry and the communities it supports. The current state of the mining industry, with its numerous challenges and systemic issues, requires urgent attention. Neumeyer believes that by implementing regulatory limits on bank shorting practices and streamlining the permitting process for new mines, the industry can achieve greater stability and growth. These changes would encourage investment in new projects, increase metal supply, and support the economic development of mining communities. In addition to regulatory reforms, Neumeyer suggests that mining companies need to take proactive steps to protect themselves from market manipulations. His company's decision to open their own mint is one such example. By taking control of their silver sales, they can reduce their dependence on the traditional banking system and mitigate the impact of shorting practices. In conclusion, Keith Neumeyer presents a compelling case for the need for regulatory reforms and proactive measures within the mining industry. The current banking practices and regulatory environment are creating significant challenges for the sector. By addressing these issues, policymakers and industry leaders can ensure a more stable and sustainable future for the mining industry and the communities it supports. Neumeyer's insights underscore the importance of fair market practices and strategic investments in meeting the growing global demand for essential metals.